Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone, to Wednesday, the 4th of October's webinar. So I'm going to be fairly brief in it today. I know we've got a lot of new users coming on. The promotional sale and the changes in the trading maximum drawdowns have gone very well. If you are still on one of the old legacy programs, so you don't automatically get upgraded. You have to either cancel your subscription and renew and take out a new subscription. It won't just automatically apply to your accounts, guys. So I just want to point that out. I think most people understand that. It's the only way we could really do it. To give everyone, equal opportunity. So if you are on a current evaluation and you want to switch over, you will need to cancel your evaluation and then switch over. So I don't want to make this into a big sales plug, but just to make that clear, I think people are still a little bit confused about that. But we're going to press on in here. It's going to be a fairly short webinar. I've not got a huge amount to say. We've been saying a lot of what I've been talking about recently has been coming to continue to be true. And I really do think that we're a cusp of potentially a turning point. I think we've got a massive exhaustion in this sell-off in the bond markets and a move to higher yields, and we could see some turning points coming. And I know most of you guys are not trading the bond markets, and even those that are trading the FX, the currency markets, the currency futures in here, who are probably watching the bond markets. But from the equity standpoint, equity index standpoint, if you're trading the S&P minis or micros, or the NASDAQ minis or micros, you really have to have an eye on these bond markets, because they are really driving what's going on in here at the moment. And another big sell-off in bonds yesterday saw a move, obviously lower bond prices, higher bond yields, and that hit the stock indices. And as the bond markets are breaking down through support levels, as they hit and break through support levels and accelerate, it's having a significant impact on the stock indices. So you really should be aware of that, right? So it's the dog wagging the tail of the bond market is the dog, and the tail being wagged is the stock indices at the moment. It's the one that's reacting. A lot of the time, the stock indices are the drivers, right? Sometimes it's FX, rarely is commodities, but in this case, the bond markets is what's really watching here. So, question from JJ: which bond do you like to track? I think the 10. The most probably important, what everyone looks at, is the 10-year. JJ, you're spot on. Okay, so you're looking at bond prices on the futures market when it breaks support. If you can't find those levels on the futures, because we're too far back in time, we're hitting levels not seen since 2007. So we're looking at continuation charts. Maybe it's better to be looking on the yield charts, because a lot of these bond yields are coming to significant levels from back in 2000, either 2011 or 2007, depending on which bond market you're looking at. So definitely the 10-year. Now, what I will say though as well is what's significant is the long ends. So the long end being, well, really the belly of the curve is 5s and 10s, but 10s at the long end of the belly, right? So you have the short end at 2 years and below, the belly of the curve 5 and 10s, and the 30-year is the long end, right? So what we've seen more recently is the longer end, so 10s and 30s have already broken down through more recent lows. Low prices and breaking up through higher yields. The shorter ends haven't done that, so I think that's going to be important to watch as well. Even though the 10-year is really looked at as more of a driver, the shorter ends, and I'll come and throw up a couple of charts if I can quickly get them up in here. But they haven't broken levels yet. So if they haven't broken, what could be interesting if they next break levels? So actually in here I've got, so I can actually, what, I keep meaning to send those reports. So I do write reports for my institutional clients. In the, just where you're watching this now, down to the right is where I share the market chartist reports that I write for my institutional clients still. And those reports that I share with you guys are on the S&P, the NASDAQ, oil and gold, because that's mostly what you guys are trading. I never bother sharing these ones, so I do write these as well on the US 30-year. So you can see in here on the 30-year, and you can see there's a load of Fibonacci extension targets here. Here's the 10-year. That'll load in a sec. There's the 10-year, and there's the 5-year. And finally, I'll load slowly, and then the 2 years. So you can see they're all in quite orderly moves up. But look, what was interesting in here, yesterday. So the 2-year note in here, okay, the 2-year note yesterday just started to break down below the low that was posted at the end of September. See, it just nudged previously. So you had this late September. So the 2-year was trying to base out in here. Why is the 2-year not moving as aggressively as like the 5s, the 10s, and the 30s? Because the 5s and the 10s or 30s are starting to price in potential stagflation, right? The longer end of the curve is more reactive to potentially the economy. The shorter end of the curve is more reactive to the central bank, in this case, obviously the Fed, right? So the longer end, the economy, the shorter end, the actual central bank. So obviously the central bank have told us what they're doing in the short term, right? They've said to us, we're going to probably hike once more and then we're going to be higher for longer. We're unlikely to be moving rates anytime soon. So that's why this is kind of stabilized. The shorter end is more stable. If you compare to, let's just jump back to the 10-year note, which has been in that protracted downtrend and accelerated in here, not only in here over the last week from late September into early October, but it's particularly this week, in the last couple of days, we've had this big acceleration down in price. Remember, equals up in yields. Okay, down in price, bond price is lower, yields go higher. But if I zoom back to the 2-year, like this is kind of struggling to break down. So there is a hint that the short end is trying to base. Back here, so this was the 21st of September. You get this low put in, then we just break the low and then rebound up back to this trend line. And this trend line has been poked at a few times in here and can't quite get back above. Look on this trend line, and it got poked at back here at the end of September. And then in the last 24 hours, we've gone to new lows and it's trying to bounce again. If we reverse this trend line, so normally, I know I'm sort of going on a bit in here, but I think it's a good question JJ's asked, and we don't often. Is JJ Jack as well? I don't know. Maybe it's the same person. But what we would normally be looking at is at the longer end of the curve, right? But I think we might get, if the short end starts to reverse, right? If you can get this short end moving above this trend line, then we could see a bit of a crowded trade, okay, in the short end. We could of shorts. We could get a short squeeze going on. Oh, John Joseph, there's a different JJ. Okay, no worries. So and we get a pop above, and obviously that trend line, which is coming in around 101.09.10 on the future in here going into today. And then 101.13.3 up here. Okay, if we can get above those resistances, okay, you could get a short end led move to the upside, so a bullish move in bonds, and that could then trigger a more bullish move in stocks. And obviously, we're seeing in here the market continue to be vulnerable in here. Look, you go look at the 30-year in here, so we are getting a little bit of a respite this morning. Look, a little bit of a bounce on the overnights in here on the 30-year and on the 10-year as well. On the futures, so we're getting this little bit of a respite, and that's giving a little bit of a respite to the downside for stocks. Obviously, stocks got damaged as bonds plunged lower again yesterday. But these turning points might be coming, and you need to be looking in here, looking at the resistance points on the bond markets. And I think that 2-year, maybe watching that 2-year first of all, but and it's pretty. Bonds, 10 years got to go all the way back up here to make any kind of significant reversal. It's not going to do that in a day. But there's some little intraday levels in here you could be looking at yourselves. Okay, doing your own analysis. And I know you're not necessarily trading these, but I think it's important to, definitely, you can't deny that the stock markets have been driven by, and I'm going to throw up if you go through Bloomberg and Reuters today, right, and over the last week, and I've been talking about this for 2-3 weeks now. Keep your eye on the bond market if you're trading stock. Keep your eye on the bond market, and every single article from Bloomberg and Reuters today is all focused on treasuries, right? It's clearly getting quite crowded, right? This trade, so the chances are it is close to reversing. If all they're talking about it and all everyone's talking about is bonds going down lower in price and higher in yields, at some point that's going to reverse, and we're getting, I think, closer to that. And if that reverses and we get a sharp reversal, okay, and it may not be, this is just on positioning, right? This may not be anything to do with any kind of macros or fundamentals. We might get a driver on this, right? And we obviously have got data coming up today, and then skipping forward, we have data on Friday, and I'll come through that it's shortly. It could see a short squeeze where the bears could get squeezed out of their shorts in the bond markets, and if they get squeezed out the shorts in the bond market, that could allow stock indices to get some kind of rebound going. Okay, so even though it sets up bearish, right, you can't deny the charts are bearish. We'll come to look at the stock indices shortly. You can't deny the charts are bearish, but then what we have to take into consideration is that if we get any kind of turn going, it could get quite aggressive. Okay, right, let's talk about that data. So we've already had, still a Chinese holiday in there. Parts of Asia still open in here. So it's a golden week in China. But look at this Eurozone from the various parts of the Eurozone, France, Germany, and the Eurozone as a whole, and from the UK as well. We've had the S&P Global, or HCOB in here, data on PMI. Okay, this is not obviously as watched for the US. We do get the S&P Global data from the US today. That's at 9:45 Eastern. But more important and more watched is the ISM data that we get at 10 o'clock Eastern. But look at the European data so far this morning. Green, 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 green across the board. Okay, so positive outcomes there, and we're seeing a little bit of a respite on the European bond markets. We're seeing a little bit of a respite from these selling pressures. Remember, I said yesterday, the European pan-European benchmark index is moved to the low for the year. The Dow Jones Industrial Average yesterday went negative, went in the red. The S&P stood up, I think that's something like 10% for the year, but the Dow is actually went down for the year yesterday. Okay, it's actually down on the year. So we're getting stock indices getting a little bit of oversold in here, and look, the data is starting to look a little bit better. I mean, these numbers are not massive beats of the expectations, but they are beats, and they're all beats for France, for Germany, for the Eurozone, for the UK. So we're watching out for that. Going into this afternoon, as I said, we've got 9:45 and 10 a.m. We have the S&P Global and then the ISM non-manufacturing / service sector PMI data. That's going to be very much watched. Ahead of there, in just over 30 minutes, we get the ADP non-farm employment change. That's the private the private monitored kind of precursor to the actual official government US employment change data that we get in the US employment report that we get on Friday, the always much watched non-farm payroll and US employment report. So maybe those give us the spark we need to kind of get some kind of rebound going. Maybe ADP employment is going to be enough. Maybe the ISM non-manufacturing / SMI data. So we're watching out for all of this. Okay, today it's all going to be important. The other thing to say is oil has reversed lower. If you go and take a look now, I'm going to quickly dip into, and it's not going to be, I'm going to hear myself in here at the moment, so we're going to do it as quick as possible. I'm going to go and get from the, okay, I'll try and do it as quick as possible. Okay, I managed to do it. So in here, oil, we've gone negative on oil, okay, on my reports here. We went negative a couple of days ago and we're staying. Look, so, but, we just nudged below that 88.19 level. We took out some other important supports on the way down. This looks like a topping pattern. Even though oil is trying to rebound, it's kind of rebounding and fading already. So oil is looking vulnerable in here, okay, and that's important as well because that's when one of the headwinds, okay, to a more positive tone for stocks, okay, because, we've had the China slowdown, we've had higher oil prices potentially going to be inflationary. Okay, one, inflationary, and two, a break on demand. Okay, higher oil prices. We need oil, we need petroleum, we need gas, and all of that can then lead to a slowdown in the economy. So a potential break on growth. So the fact that oil has rolled over and it's come back from this mystical either on Brent crude, or this is the crude future is based on WTI West Texas Intermediate, but Brent crude usually trades a few dollars above that, and it got close to that kind of mythical round number psychological $100 level. We backed off from that, so this certainly is easing some of the negative headwinds we've got. We've also obviously had the government shutdown, so some of those negative headwinds and then also we've had OPEC on the tapes in here. So Saudi did say in here that they would continue the cuts till the end of the year in here. So had the OPEC Plus review due to the global agreement. So I don't think that's actually officially out yet, but maybe we'll get some respite there. Maybe we'll get something positive in there. So sell-off in global bond markets gathered pace. Yields on 30 years hit 5% high since 2007. German 10-year reached the highest level since 2011. It's not just the US. I do see your question there, JJ. I'll come back in a second. Congress has been plunged into internal power struggle, not really going to significantly impact us. Healthcare workers strike. But, in here, bonds cool. So we say treasuries have started to rebound and oil continues to decline. WTI slipping further below the $90 a barrel mark in here. And so, say that OPEC plus ahead of the OPEC plus review. So we're going to see how that works out. We've already gone through what the data that we're going to be coming up today. So Jade's question. So short-term aligns more with Fed. Are you looking for more of a short-term around FOMC for your intraday bias as opposed to long end for overall macro? Does short-term respond more to tier one news, sort of taking you backwards? Yes and no. Really, the macro data, no. So the macro data impacts the belly and the longer end, right? So the data is usually, unless it's going to really shift the Fed, So the Fed tell us what they're going to do. So the short end is very Fed. I think I'm answering this. So the Fed is more short end centric, okay, and drives the short end, and then the short end is more U.S. central banks. FOMC Fed centric, and then the long end is more data centric, right? Okay, and it's going to be looking at growth and inflation numbers. But in this case, the reason I said so generally you'd be looking at the 10-year. The reason I said about the 2-year was more that the 2-year is showing I think it's got closer to showing the signs of a reversal on the upside. Okay, so if you get that reversal coming in the short end, okay, it could trigger reversal, and just from positioning, you could see an unwind, because if we go back to those charts, here. This is a long way from making any kind of, a really bullish signal for 10 years all the way up here, right? It's got to break that 108.14.5, and look at this trend line here. It's got to break above here, right? That's a long ways to go. And this dotted trend line is kind of tentatively in place. It's a long way to go before it breaks that. So you could have there are other little mini levels in here, but they're not as big levels, okay, that they could potentially break. I mean, there are some levels in here around 107.14.15, okay? But if we go back to that 2-year chart, what the 2-year chart is showing me is that we're much closer. Now, obviously, the 2-year doesn't move as much, right? But then the 2-year could easily make a statement through that trend line there today, okay? Whereas and that's a bigger trend line. It's a bigger resistance factor for the 2-year compared to what the 10-year can do, because the 10-year is very unlikely to be all the way back up here today. It's taken a big 2 days down to get here. I mean, a very big acceleration down. It'd be unlikely that we accelerate all the way back up there in one day. We could do, but it's more likely you're going to get the signal from the short end. I hope that explains what I was trying to say. Okay, just jumping through some of the other. I'm going to cut it a little bit shorter in here now, but basically it's just all about bonds. Global rout abates as Treasuries yields stabilise, but pointing to the big moves that we've had in here, and the dollar's slightly weakening. Obviously, the dollar's been strengthening. Higher US yields equals stronger dollar, and so the dollar with yields just kind of abating in their higher yield move, the dollar's kind of had a little bit of a move. Lower oil slump extends on fragile economic as OPEC plus meet. I don't think we've had, but Saudi Arabia and Russia will continue supply curbs into year end. That's what we're expecting anyway. Bond sell-off upends markets as long-term borrowing costs surge. It's all the same stuff. It's all bond. Bond steamroller flattens all, and then global bond rout deepens. It's all the same. These are all different articles, but all futures subdued and relentless rally in treasury yields. When it says futures, it means stock index futures. And then oil. So bonds and oil. It's all about bonds and oil and how it's impacting. Okay, oil falls over $1 on demand fears. So yeah, there's a concern, slowdown concerns. So oil is backing off because of slowdown concerns, and part of the higher oil prices created those slowdown concerns. What else do I have for you? So that's most of what I've got in there on that side. CME Fed tool in here, very, very little going on there, right? So the CME Fed tool, if you haven't used that, if you're new to the webinars, we're going to share this Fed tool. It is very useful. I look at this, most days, every other day or something like that. But this has been sitting between 70 and 75 5 for November. So that's unchanged. Not moving rates in the November meeting. If we click tabs to the December meeting, that's by the year end, still 60% chance of unchanged, right? So only, less than 40% chance of a hike. The Fed tell us they're going to hike, basically. The dot plot chart at the last meeting told us they're going to hike. Mester yesterday said they were going to hike, right? There's a good chance they're going to hike, but the market doesn't believe it. So there's a potential shock for the market there if they do hike, because the market's not believing in here at the moment. What else do I want to show you in here? Just the overnights in here. So Hang Seng was open down 0.8. Nikkei got pummeled yesterday, but remember, this is playing catch up with, this is overnight. This is playing catch up because obviously US sold off yesterday whilst Asia was closed. Europe's holding in though. We've had a bounce in the German DAX and the French CAC, only 1/4 to 1/3%, and the UK FTSE is pretty much unchanged. And then having got hit yesterday, Dow particularly 1.3% down. We've got a slight rebound, but it's a bit of a dead cat bounce so far. Watching out for those bonds. I can't stress that enough. A very, very quick, and it will be a very, oh, no, wrong one. Oh, it doesn't matter. It doesn't matter. I'll go into this one, but it's going to be very, 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 very quick in here, guys. Just want to, if it loads. So just on the stock indices, and look, you can see in here, right? So here's the Nasdaq. Now remember, the Nasdaq has been outperformed. We said about this 13-period EMA, but the Nasdaq has actually been holding in. This rebound last week into the beginning of this week was firmer on the Nasdaq, even though the Nasdaq usually underperforms. Remember, the Nasdaq usually underperforms when yields go up. Higher yields, higher interest rates, is more negative for growth stocks, and obviously a lot of the growth stocks, tech stocks are growth stocks, and tech and Nasdaq equals tech stocks, right? So the Nasdaq's actually performed particularly well, and you can see in here, despite the sell-off here, look, this morning, look, overnights, look at the low here. We just picked below these an important couple of lows over here on the Nasdaq around 14,630 to like 610, okay? And last week we just picked below there down to 14,586, and then this morning we held that low at 14,589 by 3 little just tiny little points in here. By 3 Nasdaq points we held the low and have rebounded. So last time we went down there, we rebounded. Look, hammer pattern at the bottom, boom, 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 back up again. Another hammer pattern. This is a potential double bottom forming on the Nasdaq, right? It's got a long ways to go. It's got to go all the way back up here to confirm that double bottom, but it's trying. The bulls are trying to take over, okay? Now, the ADP numbers, what we got very shortly now, could wipe that out, right? The service sector PMI data from ISM could wipe that out today, and we could be all the way back down here. But I'm just pointing out that there's a potential turning point. This 13-period EMA has done very well as resistance in the last few days. But look, when we do reverse it, the market kind of tends to try and hold on, when we reversed it back here. And it's acted as good support, and it acts as good resistance. It's a very good short to intermediate term trend change indicator. So watching, it's a long ways to go there, but you're going to be stepping in and looking at the intraday levels then, okay? And back above there on the top side, 14,785 up through there, Nasdaq starts to look a little bit better, okay? So watching out for that on the top side. On the ES, Nat, and the S&P, again in here, a big down day yesterday. Look, underperforming. It hasn't been anywhere near touching this 13-period EMA on the top side. Broke down through the low from last week yesterday, plunged through that low, but then look, held yesterday right at this retracement in here, okay? This retracement, actually, no, forget that. Oh no, it's been, I shifted it down. Let me get that on. Okay. Actually, look, rebounded from above it. So ignore that. Yeah, I didn't really hold that retracement at all. But this morning, hammer pattern again, okay? So trying to give some respite, go into the 30-minute. Really is above there. That little peak there for me. High. 42.78 up through there. It looks a little bit more positive. So those are my trigger points on the top side. And then go and do some due diligence yourself, guys. I'm not going to go through all this for you, but here's a 30-minute chart. The equivalent levels that I was just looking at and talking about there on the S&P and Nasdaq. So these little swing highs here. So these are the equivalent levels we just flagged on the upside. This is the US 10-year future on a 30-minute chart. It's already just taken that out. So we're getting the signal for a mini base here already. You might want to put this trend line on as well. So this trend line comes from, let me see this. What date have we got on this trend line? This is from the 29th of September, so just from the last week. So I think we've got some, that's no good. So we're coming up to this trend line. Just make sure I get it right on the high there. Look, it's a good trend line as well. So you get this, you get a next touch on it here. Drawn off here and here, you get a touch here and it fails, and look, we're coming up to it. That's coming in on bonds on the, sorry, this is a 10-year note, 106.25. Above there, then you get the trend line. So you're already through this Dow series, this little swing high here, and through there gives you 106, gives you a trend line reversal. So keep an eye on that. If we take that trend line out, we could get an acceleration here, watching what I just mentioned before on the 2-year, and then that could give us a real boost on stocks, on the stock indices. All right. Okay, went on for much longer than I thought today. Right, guys, I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another. I'll be back with you with another bull versus bear webinar tomorrow. Have a great one. Bye.